Well, I think that a couple of things are going on. One is that people are coming back to parks. I mean, Six Flags, I think, is an outlier. I think if you look at the industry overall, attendance is at 2019 levels or very close to it, and spending per visitor is 30% plus above 2019. So we're seeing really strong results in theme parks. But we're also seeing differentiation. And I think that those parks that skew to a more affluent consumer like Disney, like Universal, they're particularly well positioned for this macro environment. Those who skew a little bit more down market, like a Six Flags, it's more difficult. And I think Six Flags, to their credit, they see that. And they have a new CEO who has launched a strategy to premiumize, make this a more expensive park to get into, a better experience, less crowds. They launched that this quarter, but I think they fumbled the launch. And I think that, is really what weighed on the stock. But I think what you have is a good industry, but some differentiation in performance.
And they got a downgrade this morning from an analyst. I don't know if it was yours or a colleague's who was so frustrated, saying this was the quarter you were supposed to show to us that, you had what it takes. So is this then just something that we can dismiss as a challenge unique to them? And if so, what about the other amusement parks that are also down year to date?
Well, look, I think that, there is some separation in the parks. I mean, I think that Six Flags, which we've kept our buy rating on, but we were very disappointed at the quarter. Our belief is that the turnaround plan can gain some traction from here. I do believe that it makes sense. I think they have a CEO who has a history of making companies work well. And I think he'll pivot, learn, and it'll get better from what's a real low water mark right here. I think SeaWorld has already gone through this. They brought in a new, essentially lead shareholder, new chairman, who pivoted them to more of a premium pricing strategy starting in 2019. And unlike Six Flags, they've done it kind of incrementally, and they've done it without the big hiccups. And their stock had been tremendous pre-pandemic, tremendous right after the pandemic. Like some of the regional peers, they eased a little bit through the early part of this year. They've gained some momentum of late. I think what a lot of people are trying to digest right now is how much of the strength is a temporary let's party after the pandemic and how much of it persists. And, what I think we've seen before is the consumer is spending more on out-of-home leisure. That was a bigger part of their expenditures going into the pandemic. I think coming out of it, I think that if anything, the more time that we spend in front of computers, telecommuting, teleworking, makes us more interested in those fun things that we can do in person.
Yeah.
So, I think the macro backdrop is helpful, but you have to manage it well. And I think we're seeing some differentiation there right now.
You're sticking with the buy rating on Disney. You've got a buy ratings on SeaWorld, and still on Six Flags, even though you're neutral on Cedar Fair. I mean, why isn't Six Flags a downgrade for you at this point?
Well, I mean, to be clear, there was a real moment of truth yesterday to think about it. And part of it is that this is a stock that, has been reset. Expectations have been reset. But this is not some fly-by-night technology that's kind of big on tomorrow. These are iconic parks in major urban markets with a CEO who has a history of great success at other companies and with a plan that I think makes sense once it's executed correctly. So, I think our belief is they can improve from here and that these businesses are here today, they're here tomorrow, they're here for our children, our grandchildren. So it's the type of thing as a value investor, these are the moments you look for.
By the way, Barton, I'm so used to talking to you about some of the internet and media stocks. I didn't even know that these names were in your coverage universe.
Yeah. Look, it's certainly I'm probably the only investor or sell-side analyst on the planet who covers Cedar Fair and Amazon. But it helps keep me rooted in reality, right? Everything in life is not just electronic, not just virtual, but looking at real things that people do. It's a great comp for Disney. And fun kind of places to do due diligence.
So then final question then, overall, given all these different touch points you have, do you think the consumer is shaking off the recession, inflation hit or not? I can't quite tell what the takeaway is here other than maybe the squeeze on the middle income and lower income.
Look, I think there's clearly a squeeze on the lower income. And I think the differentiation between Disney and Six to some degree speaks to that, But I think that the consumer, at the middle and upper income levels is very strong right now. They have jobs. They want to have fun. They can afford to have fun. And, knock on wood, hopefully that persists for a while.
All right, Barton, thanks for your time. We appreciate it.